What is a home equity agreement? So, this is kind of an interesting product that's been out for a little bit. And I got a request from a friend of mine. He said, "Hey, what is a home equity agreement? And is it better than a HELOC? Is it something that I can utilize um, to help me with some financial things I have going on?" So, did a little research just because it's not a product that we use very often here. And I have some details about what they are, whether or not they're a good idea, in my opinion, and what you could do alternatively. So, hey, I'm Dave Evans with VIP Mortgage and just want to touch on home equity agreements. So, there are some interesting details to home equity agreements. The first one being that there are no payments associated with the agreement. So, once you strike one of these loans or one of these agreements with a bank, with an investor, there are no payments associated. Another benefit is it requires very little FICO score. So you can have a very low FICO, average that I saw somewhere between 500 and 540. Of course, the terms are all affected on the loan that you would take out based on your credit score. That's one of the things they look at. The other interesting feature is there is no interest associated with this type of loan, which I thought was kind of a unique feature, but when you kind of see why, it makes sense. You're actually going to pay a ton of extra money that they're not calling interest, that I kind of assume to be interest on a loan, because anytime you take out a loan and you have to pay more back, you can call it whatever you want, but interest is kind of the easy word, even though they don't use it. They actually advertise these as no interest loans, and you'll see why. Basically, the way it's paid back is it's a lump sum payment at the end of your term, or if you refinance or sell the house. And there are fees up front, typically ranging from 3.5% to 4%. So, how does this work in general? You enter into an agreement, similar loan setup. They go out to the house, they do an appraisal, they take into consideration the equity that you have into the home or that you have established in the home. They look at the liabilities on the home, and they will provide you an offer for a portion of the equity in the home. It's not as high generally, from what I've researched and what I've seen, as you would get with a regular home equity line of credit, but it is a lump sum payment. So you would get all of the money up front, and again, no payments associated with it, and no quote unquote interest on that money that you're borrowing. What you are doing, though, is the bank then goes into second lien position on the home, right behind your first mortgage or whatever loan you have on there. So they'll go into second position for an agreed amount of equity growth over the term of the loan. So if you take out the loan for 5 years, they're saying, hey, we want a portion of the gain in equity on the property at the end of the 5-year or 10-year or 15-year term, whatever you decide. Some of them do go up to 30 years, which I thought was kind of interesting. So let's say in the 5-year term, the value of your home goes up $100,000, and you've agreed to give up 20% of your equity growth. Well, you would be paying $20,000 to the bank at the end of that 5-year term out of the equity of the home. So it's kind of an interesting math problem. If you live somewhere where property values are going to go up, which we've seen, we think that is going to be the case, then you will owe more and more back to the bank for this home equity agreement at the end. Property values drop, it's not a very good investment for the bank. And they would just basically be getting their upfront fee somewhere between 3.5% and 4% of the loan that they give you. So is it a good idea? That's tough to say. You'd have to look at your individual situation. But to get access to a portion of your home's equity for no payments, although enticing, you are kind of gambling a little bit on the fact that your home's not going to appreciate that much and how much of that equity you would give up. It can be, 15%, 30% of the growth, 20% of the growth, whatever terms the bank will offer you on, hey, we want a significant portion of the growth of the value of the property. In my opinion, if you have good credit and you have the income to support a home equity line of credit and you need access to cash relatively quickly and you don't want to refinance your first mortgage, I would say go get a home equity line of credit. There's lower fees associated with those. The interest rate, although variable, is probably going to be much lower than a lump sum percentage of the equity in your home when you sell. So I think if you have decent credit and you can qualify for a home equity line of credit, that would be the way I would go before doing some sort of home equity agreement. So hopefully that helps. Hopefully that kind of breaks down the difference between a home equity agreement and a home equity line of credit. I would prefer to see my clients do home equity line of credit, because then if you get the opportunity to pay it off early, you can just pay it off early. You can pay it down, and you're paying significantly less interest. Where on the home equity agreement, it's kind of a lump sum payment at the end, and it's a portion of the growth of equity. So it just doesn't seem like a great idea. I guess if you had really low FICO, you couldn't afford extra payments, and you were interested in giving up a portion of the equity growth of your home over the next 5, 10, 15 years, I guess then maybe you would think about it. But I can't think of any situation where someone would have high FICO and the income to support a home equity line of credit where I would recommend this type of product. So there, hope that helps. Difference between home equity line of credit and home equity agreement. Hope you're all doing well. If you have any questions about this, just drop me a message. We'll talk to you later.